Good morning and welcome to Monday morning's market wrap. It's the 14th of September and I'm Greg McKenna. You would have heard by now that markets have been quiet and volumes are down and those sorts of things in global trade on Friday. And certainly that was the case. The Australian ASX market volume was 2.6 billion as opposed to its normal 4 to 4.5. Volumes are down in US. But even as we go into this period pre-FOMC, which is out at 4 o'clock on Friday morning Australian time, there are lots of trade opportunities. If you have a look at the price of oil and the pattern in oil, if you have a look at the ASX 200, if you have a look at the the S&P 500, if you have a look at the Aussie dollar, which has probably got a cent in it also over the next little while, if you have a look at the euro, if you have a look at almost any market, there's lots and lots of opportunities starting to build. Now, the FOMC is likely to be a somewhat digital event. You know, they're either going to tighten or they're not. They're either going to be hawkish or dovish or they're not. And it's unlikely that we'll get to the point that traders in New York will go, oh, well, that was fine. So what's really important this week is sitting and being patient and waiting for what is going to happen on Thursday. Now, that doesn't mean you don't trade, but as this great quote here from Jesse Livermore, I don't know, how do I increase the size of this? Zoom, let's blow it up to 150%. Right, after spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. And that's what's going to be the challenge this week. That's why this week could actually be more volatile than many people think. Because traders, often find a reason to try and do something, to try for action, when in reality, sometimes there just is no action. But what happens there, and what we're going to see this week is we're going to see thinner volumes, positions held with less conviction because people aren't sure what's going to happen. You get these little whippy moves, and ultimately you'll probably get some sort of a breakout either top side or downside come Friday morning. In the intervening period, we have to have a lot of waiting and talking and that sort of thing. But I think that this is a really important week. There's always another chance to make another trade. So sometimes being circumspect is the single best trade you can do, sitting on your hands. And I'm not saying don't trade this week. That's not my story. That's certainly not what I'm going to do. But you just need to be careful and don't rush the trades. If you've got a process that you normally use, then stick to that process. And if the trades that you want to take don't fit that process or your signal's not given, don't rush it because you haven't made a trade today on Monday, or don't make a trade tomorrow on Tuesday or whatever. There's always plenty of opportunities. You know, you can have 3 months off and come back and make money. You've just had 3 months off. The markets haven't changed. The markets don't change. You know, for all the robots and all the algos and all that kind of stuff, fear, greed are still the dominant emotions in markets. You know, technicals still work, lines still break, ranges still break, ranges hold. You know, those kind of things. You still get these kind of moves. So I guess my as boring as it's going to be to hear me and others write, well, it was very quiet. That's the reality, and so that's what we're going to have to face. Now, how do you catch fish? You catch fish by being patient, don't you? Have you ever caught fish when you're tense on the line? I remember as a kid learning to fish with my dad. He always used to say to me, just relax, son. They can tell. And that was a great lesson. I always catch fish. Not that I go fishing that often anymore, but whenever I go fishing, I always catch fish, at least 4. It's just the relaxation, the patience. It will come. Trading's no different. But anyway, going back to Friday night, the tension is still palpable in markets as to what's going to happen. But Friday night saw US markets rally. The Dow Jones, NASDAQ and S&P are up 0.63, 0.54 and 0.45% respectively. The S&P is still within that wedge that we've been seeing for a little while now. And it's wedging itself towards resolution, but certainly we're not there yet. But as you can see on the chart here, nice little 4-hour chart. If we can extend that a little, You know, when have we got? We've got 11th. You know, sometime out here later this week, we're going to be in this 1990 region and waiting for a breakout. The Aussie dollar similarly looks to me be moving nice technically. I'll blow that one up a bit too so you can see it. So what we've got here, we've had this. This is where we got long. This is where we took 50% off. When I say we, I mean me. And this is where I'm targeting into this zone here. This zone here, 71.70 to around 71.85. So somewhere in there, it's probably, you know, another sort of 60 to 80 points in it. And then I'll have a look on a medium-term basis. Obviously, the Aussie's been aggressively sold. It's only had 1 week of recovery, but you know that 72 cent region looms large, and we'll have to see what happens if it can get back there. If we think about the rest of the markets in Asia today, we're likely to be impacted by what's happened in the Chinese data over the weekend. My colleague David Scutt has put something out on Business Insider this morning saying that the data was generally weak. Retail sales certainly were a little bit disappointing. That's not right. I've got that one back to front. They were better at 10.8 than the 10.5 expected, but the investment data was the lowest since 2000. So retail sales okay, investment data not so okay. Given the importance that investment plays in the Chinese economy, they'll probably be seen as a net negative. But overall, that means that there's more stimulus coming, and the Chinese have to give more stimulus. They really do if they want their economy to to continue to grow at the pace they wanted it. There's nothing wrong with 4 or 5% growth, but it's certainly going to feel like a recession in China if they let it slip there. Citibank put out a piece, which you can find on Business Insider as well, on Friday night, saying that China is going to drag everybody into recession. So that's never a good sign for the Aussie, which is one of the reasons why I'm short-term bullish Aussie, but longer term still bearish. The market is very short though. If the Fed passes and is dovish, which means that they talk down the prospects of an easing or they tightening, or they talk down the prospects of the US economy, then the US dollar is going to get absolutely poleaxed. You'll see euro back at 115, something like that, and you'll see Aussie taking out 72 cents. But we'll have to wait and see. I've written a piece of Business Insider today where I look at the 4 scenarios from Morgan Stanley. They think a dovish pass, which means that they talk softly about the economy, is a 60% chance, 30% chance of a hawkish pass, and then they've got dovish tightening and hawkish tightening. I think that we're more likely to see a dovish tightening along the lines of a one and done. We've moved, it's out of the way. Let's get on with it, see how the economy goes. I think that's really important. If you think about what the Bank of England's Wheel said, MPC member, on the weekend, it's time for interest rates to start moving higher. And even though Bond God Jeff Gundlach, you can also find his article on Business Insider, talked about don't go yet, Janet, and used the Rocky Horror theme, which was pretty cool, and does make a reasonably solid case. It's all about markets. Is it the Fed's job to protect the US economy, or is it the Fed's job to protect markets? For the last 6 years, it's been all about markets in an effort for that transmission mechanism to go through to the economy. At the moment, though, you'd probably argue that the economy could do with 1 or 2 nudges, but it's not going to go as high as people thought. Where a Fed rate's going to go 2%. If the US economy can't take a 2% cash rate, then we are all in real trouble. I'm with Albert Edwards. I think they should go. I'm with Bill Evans, who says they should go. But I'm also with Albert Edwards, as I think that there's a deflationary spiral coming. Speaking of which, competing timeframes in oil, if I have a look at the oil chart going back to 1999 and the I'm just going to share my chart with you. I don't know why that got up to 200%. If we think about my short-term trading, I think there's a real chance short-term that oil might bottom a tiny bit. There's a nice flat bottom on the dailies. But if you have a look here, and I'll show you that in a moment. Have a look. This is the big uptrend line that took oil to $3 billion or whatever it went to, 150, and then back down with the GFC and then higher once again. So this is the 1999 trend line. So we've had 1 touch, 2 touch, 3 touch, 4 touch, 5, 6, 7, 8, 9 touches, few touches here, and now we've broken down. We've broken down and then we've retested. Why am I talking about a long-term monthly chart in oil when I've just said short-term? I think it looks okay as long as it holds above the bottom. The reason for that is that Goldman Sachs put out a piece over the weekend saying that oil's going to 20 bucks. Now, you can find it at Business Insider under the Goldman Sachs oil price on the verge of plunging to 20 bucks a barrel, and you'll find it there. But if you have a look at the short-term oil chart, what you see is you see a nice little bottom here. So from my point of view, long with a stop under this low here is my position. That's how I'm trading it. Longer term though, my expectation is it still gets into the 30s. So I don't know about goldies. I don't know if it's going to get into the $20 region. We'll have to wait and see. But you know, time's going to tell on that one. Now, getting back to the markets, bonds in the US rallied a little bit, down 3 points on the 10 years to 2.19%. That's helped Aussie bonds a little bit. Aussie bonds are now down at back at 272. They've been in that sort of that 265, 275, 278 range for a little while. Nothing really going there. The Aussie's at 70.85 with a little bit of a push higher. Don't be surprised if you see Euro up at 114 later today. Watch Dollar Sing. Dollar Sing's one of my favourite trades at the moment. I think on a long-term chart we might have seen the top. Small short there. I know it's an interesting one to trade Dollar Sing, and not many people do. It's a bit like taking on the Swiss National Bank when you take on the MAS. But it's different, of course. My view on that is that we are going to see dollar Sing lower. It was lower on Friday night. It's recovered a bit from the lows, but I'm looking for 140 or something like that. Elsewhere in Asia today, it's really going to be about what happens in Chinese markets, what Japan and the Nikkei do. On a data front point of view, there's nothing out in Australia, nothing material anyway. And then if we look at, pardon me, if we look at Europe, where's my 20-second guide? There's a tiny bit of data out in. Sorry, I've got the flu. I'm a bit ordinary today. I know. Fairly quiet. Japanese industrial production. How could I forget about that? Swiss import prices, retail sales, Italian CPI, and EU production. So very quiet. No excuse to trade. Plenty of excuses to exercise the option to not trade from traders. Not going to be one of those periods where I rush it. So, but there are plenty of setups. Have a look at your charts. You'll see so many setups. Whether it's dollar CAD looking like it might have peaked. The NASDAQ, see the issue I have though, and this is why I'm not going to preempt anything, is if I look at, say, the NASDAQ or the S&P or the ASX 200, they all look like they're going to break down. Now that would be consistent with a Fed hike. But dollar CAD also looks like it's going to break down. That would be consistent with a Fed hold. The Aussie dollar has got, because everyone's short, it's probably got and the chart pattern, has got a bias to break higher. That would equally mean that they hold pat. So there's some confusing signals in markets at the moment. I'm just going to go with the breaks when they come. And I'll just remind you of what Livermore said. Over many years and making and losing millions. Don't forget this was in the 20s, and before that, you know, the turn of the last century, not the one that we've just had. It was his patience that did it. It's like fishing. Trading's like fishing. Sometimes you just got to sit. So anyway, that's enough from me. I'm rambling. I apologise. I'll be back tomorrow morning at 9 o'clock. I'm Greg McKenna. Have a great day's trade. You can find me on Twitter, my website, gregmckenna.com.au, and of course at Business Insider. Have a great day. Bye for now.